Imagine a vault, deep within the global financial system, so secure that its locks are not made of steel but of complex international agreements, economic sanctions, and decades of monetary policy, and inside this vault lie the true, dormant values of currencies like the Iraqi dinar and Vietnamese dong, values that have been suppressed, manipulated, or simply waiting for the precise geopolitical moment to be unleashed, and that moment, according to a confluence of signals so subtle they are almost imperceptible to the untrained eye, is aligning for the year 2025 in a way that has never happened before. This is not the loud, chaotic world of the stock market or the speculative frenzy of cryptocurrency. This is the slow, deliberate, and silent chess game played by central banks and international financial institutions, and we are here to decode their moves. The first and most profound signal is the accelerating, undeniable global shift away from the US dollar as the world's sole reserve currency, a movement known as de-dollarization, which is creating a power vacuum and a frantic scramble for viable alternatives. For nations like Iraq, blessed with immense oil wealth, and Vietnam, an ascendant manufacturing and technological powerhouse, this represents not just an opportunity but an existential necessity to have a currency that reflects their true economic strength and facilitates trade outside of the traditional dollar-dominated system. Think of it this way: if you are Iraq and you want to sell your oil to China or India, and they want to pay you in their own currency or a new BRICS-backed currency, continuing to use a vastly undervalued dinar creates an accounting and logistical nightmare, effectively acting as a barrier to your own economic sovereignty and growth. The same applies to Vietnam, whose exports are flooding global markets. A stronger, internationally recognized dong would streamline trade, attract more sophisticated investment, and finally allow the nation to capture the full value of its economic output rather than seeing it diluted through an artificially weak currency. This is not a theory, it is the practical, on-the-ground reality forcing the hands of the Central Bank of Iraq and the State Bank of Vietnam. They are being pushed by the irresistible tides of global commerce, not by the loud demands of speculators. The second silent signal is embedded in the very specific, technical, and recently implemented monetary policies within these countries, policies that are the essential precursors to any potential revaluation. In Iraq, the most significant move was the dramatic raise of the exchange rate by the Central Bank of Iraq in late 2023, a move that was not a revaluation but a critical calibration, a necessary step to stabilize the official rate and bring it closer to the parallel market rate, effectively tightening the spread and creating a more unified and manageable currency environment. This was not done in a vacuum, it was a deliberate, painful, and necessary surgical procedure on the Iraqi monetary system to stop the bleeding of its foreign reserves and to lay the groundwork for the next phase, which is international acceptance. Furthermore, the relentless pressure from the international community, particularly the United States Treasury and the International Monetary Fund, for Iraq to comply with anti-money laundering and counterterrorism financing protocols, while often framed as a hurdle, is actually a silent blessing in disguise. Every new compliant banking regulation, every implemented financial transparency measure, every effort to curb the flow of dollars to Iran and Syria, is another brick laid in the foundation of a future, credible, and internationally trusted Iraqi dinar. They are being forced to clean their house, and a clean financial house is a prerequisite for a strong currency. For Vietnam, the signals are equally potent but expressed through its explosive economic performance. The State Bank of Vietnam has been meticulously building its foreign exchange reserves to record levels, a classic and powerful defensive move that signals strength and stability to the world. A large war chest of foreign reserves allows a central bank to defend its currency's new, higher value against speculators once a revaluation is announced. They are not just hoping for a stronger dong, they are arming themselves for it. The country's stunning success in attracting foreign direct investment, becoming a primary alternative to China for manufacturing, and its strategic positioning in global supply chains means that the economic fundamentals now overwhelmingly support a significant upward adjustment in the dong's value. The market forces are already there. The official recognition of those forces through a revaluation is the logical, and perhaps final, step. This convergence of a global monetary paradigm shift and internal, foundational financial reforms creates a set of conditions that is uniquely potent for 2025. The silence from the central banks is not the silence of inaction, it is the silence of intense focus and preparation, the quiet before the storm of economic change that will redefine wealth for those who have positioned themselves accordingly. The vault is being unlocked from the inside. Now, let us pull back the curtain on the second act of this grand monetary play, moving beyond the why and delving deep into the how, the precise, almost surgical mechanisms through which a dual revaluation of the Iraqi dinar and Vietnamese dong would be orchestrated and activated in the global financial system, a process that is less like flipping a switch and more like a carefully sequenced launch of a spacecraft, where every system must be green before the final command is given. The first and most critical phase, which we are arguably in the midst of right now, is the period of covert international compliance and financial infrastructure hardening, a behind-the-scenes undertaking where the central banks of Iraq and Vietnam, under the direct guidance and pressure of the International Monetary Fund, the World Bank, and key global players like the U.S. Treasury, are methodically upgrading their entire financial ecosystems to withstand the tsunami of capital and scrutiny that a new, higher currency value would bring. This involves the relentless implementation of sophisticated digital tracking systems for every large-scale transaction, the rooting out of corrupt banking officials who have profited from the old, weak currency regime, and the establishment of airtight agreements with correspondent banks in financial hubs like New York, London, and Singapore, ensuring that once the new rates are live, they can be seamlessly processed and honored worldwide without a hitch. For the Iraqi dinar, this has meant a brutal but necessary crackdown on the illicit dollar auction and the smuggling of dollars to neighboring nations, a process that has caused short-term pain and liquidity squeezes but is absolutely essential for long-term strength, as it proves to the world that the new dinar will not be a vehicle for financial terrorism or money laundering but a legitimate, stable store of value. Simultaneously, for the Vietnamese dong, this hardening process is visible in the State Bank of Vietnam's aggressive accumulation of foreign exchange reserves, which have soared to unprecedented levels, creating a formidable financial firewall that can defend the new, higher exchange rate against any speculative attacks from international hedge funds looking to profit from volatility. Think of these reserves as a nation's ammunition. Vietnam is not just gathering bullets, it is building an arsenal, signaling its unwavering commitment to maintain whatever new value is assigned to the dong. The second phase of this activation is the masterful management of public and market psychology, a global whispering campaign designed to prepare the world for the shift without causing a destabilizing panic or a speculative frenzy that would force a premature implementation. This is where the silent signals become a form of high-stakes communication, where every vague statement from a finance minister, every strategically leaked report from a quasi-governmental economic institute, and every minor, technical adjustment in interbank exchange rate bands is a carefully placed piece of a puzzle, intended to be seen by institutional investors and sovereign wealth funds but not necessarily by the general public. The goal is to create a state of controlled anticipation where the smart money begins to slowly position itself, providing a steady, manageable inflow of capital that strengthens the currency's foundation organically, rather than a sudden, violent flood that would break the system. The recent, almost casual mentions in global financial media about the undervaluation of the Vietnamese dong and the untapped potential of the Iraqi economy are not accidents. They are the seeds of a narrative being planted, a psychological priming of the market to accept a new reality. The final, most dramatic phase is the activation sequence itself, a tightly coordinated, likely weekend or holiday event where the world's major financial platforms, the IMF's own database, Bloomberg, Reuters, XE.com, and the core banking systems of the G20 nations, simultaneously update their systems with the new, permanent international exchange rates for the dinar and the dong. This is not an event that will be announced with a press conference beforehand. It will be discovered, a fait accompli that the world wakes up to, a financial reality that has already been locked into the global system. The central banks will have pre-positioned liquidity with their international partners, the compliance gates will have been raised, and the new, stronger values will be presented not as a speculative win for a few, but as a formal, long-overdue recognition of the true economic standing of two nations finally taking their rightful place on the world stage. This dual activation creates a synergistic effect, lending credibility to both events. The revaluation of one is reinforced by the revaluation of the other, creating a powerful narrative of a global financial rebalancing that is far bigger than any single currency, a definitive signal that the era of a single, dominant reserve currency is over and a new, multipolar financial world has officially begun, with the dinar and the dong as two of its cornerstone assets. So, we find ourselves at the precipice of a new financial dawn, having decoded the silent signals from central banks and mapped the intricate activation sequence for a dual RV, which brings us to the most critical and personal question of all: what do you do now, in this period of pregnant silence before the storm of change? How do you position yourself not merely to witness history but to actively participate in the wealth transfer that it promises? The first and most fundamental step is to achieve a state of unshakable psychological clarity, to fully internalize the monumental scale of what is being prepared and to purge from your mind any last vestiges of doubt or the short-term, reactionary thinking that has characterized the long, weary years of waiting. This is no longer a speculative game played on the fringes of the internet. The evidence we have laid out points to a convergence of geopolitical, monetary, and systemic factors that are too powerful, too aligned, and too irreversible for this to be anything other than the final chapter. Your mindset must shift from that of a hopeful spectator to that of a calm, prepared executor, because the moment the new rates go live, a psychological tsunami will engulf the global community of holders, and amidst the chaos of emotion, elation, and confusion, only those with a preformed, Steeled resolve will be able to navigate the subsequent steps with the precision and clarity required to secure their financial future. The second step is to engage in meticulous,